everyone, welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Sam Vecht, manager of the BlackRock Frontiers Trust. Hi Sam.
Hi.
So we've seen a couple of flat years from the trust, which of course followed a couple of incredible years. I mean, 45% in 1 year is pretty nice. From an investor's point of view, obviously they're going to prefer those multiple double-digit years. Where are we in the cycle? Are we flat or are we on the growth cycle?
It's clearly been a challenging couple of years for emerging and indeed frontier markets. I would suggest, given the extent to which these markets have derated, both in terms of the valuations and also the extent to which some of the currencies have fallen, I think the golden rule about investing in emerging and frontier markets is you buy when the currencies are cheap and the markets are cheap, and both of those are true today.
Of course, we said the returns have been flat, but given the backdrop, as you alluded to, that's been pretty impressive in itself, because people who have been looking at sort of investing in a passive fund, in a tracker, have lost up to 15% in the last 18 months and more. I mean, how have you achieved that? Is it because of the structure of the trust?
I think it's a couple of things. One, it is the structure of the trust. We are closed-ended, and that gives us the ability to invest for the long term and not be overly obsessed with weekly and monthly performance. But it's also been about asset allocation. The fact that we know the size of the fund and we deliberately have a very liquid fund, despite these markets being relatively illiquid, has allowed us to move from certain countries to other countries over this period of time. It's been really important. We've taken money out of the Middle East, put it into South Asia, put it into Argentina. A lot of the relative performance has been a function of asset allocation. Of course, some of it has also come through stock selection.
Looking then at asset allocation, if you look at the regional breakdown, it is very diversified. Bangladesh, Pakistan, Argentina, as you said to there. Why are you picking these places? Is it macro? I mean, Middle East, did you move out of there for macro reasons, or is it very much bottom up?
It's a combination of both. For us, what we're always looking for is countries with surpluses on the budgetary side, on the current account side, where we can also find stocks which have decent dividend yields and are relatively cheaply valued and are growing. Trying to find that combination at the same time with countries where the political situation isn't getting worse, it may not be good, but it's not getting worse, that's actually quite challenging, and that's what we spend most of our time doing. The reason why we sold some of the Middle East, apart from the oil price beginning to go down, although it's obviously subsequently gone down a lot more, was really that many of the stocks had hit our target prices. When stocks hit the target prices, we sell and find other interesting opportunities. Conversely, if we think about parts of South Asia or indeed Argentina, we could find a whole raft of stocks that were cheaply valued, had good growth opportunities, and were actually not just growing, but generating proper cash flow, and cash flow is absolutely the focus.
And is that where you're seeing the opportunities for the future then? Is it in Argentina and Southeast Asia?
It's in South Asia, more than Southeast Asia. It's in Argentina, and I'm sure over the next couple of years, given how much some of the markets in the Middle East and in Africa have fallen, there will be interesting opportunities there once again. But it's all about price of currencies and price of stock markets, much more than what appears on the news, what appears in the media. It's really, really important. It's not about themes, it's about the price one pays. There's nothing wrong with taking risk, providing it's reflected in the price.
I suppose that's no different from any investing then. Just because it's got Frontier on the label doesn't mean that you're looking for anything different within a company.
Absolutely not. One has to do a lot of on-the-ground research. We won't invest in a company unless we've met them. Typically, we meet companies 5 or 6 times before we invest. We won't invest in a country unless we've been there. So we spend a lot of time going to interesting and less interesting countries around the world. So there's a lot of time spent on the ground. But once you've met the companies, you've got to really make sure that what they say is actually true. And therefore, it's really important to meet not just the companies, but their customers, their suppliers, and their competitors to ascertain what's really going on.
So investors then should put aside the sort of scaremongering which surrounds China, which surrounds the Middle East at the moment, and focus then just on fundamentals.
Fundamentals are absolutely critical. I would say when it comes to frontier markets, they're slightly different to emerging markets. They are not very correlated either with each other, with emerging markets, or with the developed world. So whereas emerging markets do very much move with what Yellen's saying or worries about China, and that takes all of emerging markets down or up together, frontier markets are far less correlated, which means one very important thing. Although each of these markets are very volatile by themselves, Nigeria, Pakistan, Bangladesh, when you put them all together, you end up with an investment trust that is remarkably, over the last 5 years, less volatile than the FTSE, considerably less volatile than the FTSE. Now, that would surprise many people, but it's actually borne out by the data.
I suppose one last thing then, is there a no-go area for you at the moment?
Anywhere subject to sanctions, US sanctions, UN sanctions, at the right price. No, there are no-go areas. There are no-go areas. Currently, we have very limited exposure to a place like Nigeria because we think the currency is overvalued. And if we think the currency is going to fall 40, 50%, then you really don't want to be in the equity market at all.
Sam, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.